Hello everyone, and welcome back to Dr. Tao's Quant Lab. This week, we're returning to our classic 7 fundamental analysis format. We have a highly dynamic lineup, perfectly balancing the extreme momentum of the semiconductor and software sectors with the ultimate low volatility value anchor. What makes this session exciting is that we are recalculating the structural gravity for 6 newly renewed tickers, fresh off their earnings, while introducing one brand new stock to our dashboard. We will be covering this alphabetically. Advanced Micro Devices, AMD, AppLovin, APP, Berkshire Hathaway, BRK.B, Fortinet, FTNT, Palantir, PLTR, or new strategic addition, Qualcomm, QCOM, and XYZ. Before we dive in, please note the disclaimer on the screen. This is an independent educational project. The views expressed are my own, and this is strictly for educational purposes, not financial advice. If you want to study the underlying mathematics of these models, please refer to section 1.7 of the main Quant Lab course. To understand exactly what the market is pricing in, we mapped out the stock's gravity using our valuation thermometer. Please feel free to screenshot the slides as we go through them so you can study the coordinates later. Here is how to rate these core segments on our dashboard. Range 1, the blue box, is the deep value floor. This is the absolute worst case scenario, pricing based on strict forward estimates. If a stock falls in here, it is experiencing massive market capitulation. Range 2, the red box, is the expected target. This is our core fundamental fair value zone. The middle of this box represents the historical median multiple. If a stock has heavy stock-based compensation, we will also plot an orange box representing Wall Street's adjusted non-GAAP expectations. Statistic range, the purple box, is the micro-statistical boundary. This uses a mathematically normal 90-day standard deviation band to show us the immediate short-term algorithmic momentum. Finally, at the bottom of each matrix, we track 3 vital dates. The last report date, the next report date, and the statistical analysis date. Do not ever trade on obsolete data. Let's look at the charts. Kicking off our weekly 7 fundamental analysis, we are diving straight into the semiconductor super cycle with AMD, Advanced Micro Devices. They just reported their earnings on May 5th, giving us completely fresh data to work with. The current price is $444. Let's look at exactly how extreme the AI momentum premium has become. I want you to look at the massive gap on the right side of this chart. Even when we give AMD the benefit of the doubt and use the orange non-GAAP target, their absolute fundamental ceiling is 321. Not only has the current price for 44 completely detached from the structural fundamentals, but it has violently grown past the absolute +1 standard deviation ceiling of its 90-day macro statistical band, which is 314. This is the visual definition of pure momentum hype. The stock has outrun its own massive forward growth estimates. For left side fundamental buyers, there is absolutely zero margin of safety here. You are paying purely for a future narrative. but current cash flows, not current cash flows. For right side momentum traders, this chart is screaming caution. The stock is operating entirely in an air pocket without any algorithmic or fundamental support benefit. If you are holding, this is the exact moment to rigorously tighten your trading stops. Next up is our post-earnings lineup. We look at the high beta, hyper-growth software name AppLovin, APP. They just reported their new numbers on May 6th. The current price is $4.54. Let's look at what a perfectly balanced growth chart looks like. Look at where the black current price line is resting. It is sitting perfectly inside its 90-day macro statistical range, just a few dollars below its momentum median of 470. At the exact same time, it is embedded beautifully inside the lower half of its macro expected target, or the red box, sitting safely above the fundamental floor of 419. Notice how massive that red box is. Because of their forward growth estimates, the structural ceiling stretches all the way up to 614. This is a brilliant example of a healthy technical consolidation meeting strong structural growth. The stock is not algorithmically overheated, and it has not overrun its true fundamental gravity. For left side accumulation, this is a highly logical entry zone. You are buying right near the medium of both historical momentum and fundamental value, giving you a massive runway before the stock hits true macro resistance. To completely reset our palette from the extreme beta of the tech sector, we turn to the ultimate structural anchor of the entire market, Berkshire Hathaway, BRK.B. They reported their fresh data on May 2nd, and this chart provides a masterclass in low volatility fundamental safety. The current price is $4.82. Let's look at what true unbreakable structural gravity looks like. Look incredibly closely at the purple stat range, comparing to the massive momentum bands we saw on AMD and Palantir. Berkshire's 90-day momentum band is completely compressed, spanning less than a $25 width. Now look at the fundamental range. The current price is nested perfectly inside the red fair value box, resting exactly on its statistical momentum median of 485. This is exact definition of a sleep well at night asset. There is no algorithmic hype. There is no technical overextension. And there are no fundamental air pockets. The stock is perfectly priced according to its slow, steady cash flow generation. For portfolio construction, this acts as your ultimate low beta ballast. You hold this precisely so you can afford to take those higher risk right side momentum shots on the tech names without blowing up your structural foundation. Okay, moving forward with our renewed earnings group, we shift into the high margin cybersecurity space with Fortinet, FTNT. They just reported fresh data on May 6th. The current price is 114. Look at the shear detachment on the right side of this thermometer. Fortinet's macro fundamental expected target has a strict mathematical ceiling of $84. Not only has the current price completely outrun its historical fair value, but it has also violently broken above the absolute ceiling of its 90-day macro statistical momentum band, or $91. The algorithms have completely abandoned the structural gravity of the stock. This is a classic overextension. The stock is operating entirely in the technical air pocket. For left side fundamental value buyers, the math is telling you to stay far away. There is absolutely zero margin of safety here. For right side momentum traders, this massive double breakout acts as a glaring warning light. The stock is perfectly priced for an algorithmic mean reversion. So it is critical to ruthlessly tighten your trading stops to protect those momentum gains. Continuing with our high beta software and AI segment, we bring up Palantir Technologies, PLTR, which reported its earnings on May 4th. The current price is 130. I want everyone to take a step back and just look at the absolute visual detachment on this thermometer chart. Despite Palantir's incredibly strong forward growth estimates, its macro fundamental expected target, the red box, has an absolute strict maximum ceiling of only $50. Meanwhile, the stock is currently trading in a completely different universe at 130. However, notice what just happened technically. The current price has violently cracked below the absolute floor of its 90-day macro statistical momentum band, 134. This chart perfectly illustrates the danger of a pure momentum breakdown. The algorithms have been dragging Palantir higher for months, but that short-term momentum has just fractured. For left side for fundamental buyers, this is entirely untractable. The air gap down to historical fair value is $80 wide. You are paying purely for the future narrative. For right side momentum traders, the broken statistical floor is a glaring red flag. When a stock falls out of its momentum band with no fundamental parachute underneath it, capital preservation and strict risk management must be your only priorities. Next, we're introducing a brand new strategic addition to our lineup this week, Qualcomm, QCOM. They just reported fresh data on April 29th, and this chart provides a fascinating lesson in what happens when negative forward growth collides with extreme algorithmic hype. The current price is 214. Let's look at how Wall Street's math is conflicting with current price action. The first thing you will notice is that range 1 and range 2 are actively overlapping. This compression happens because Qualcomm's forward growth estimates are actually negative right now. Despite this shrinking fundamental gravity, the current price has violently broken down above the absolute ceiling of its 90-day macro statistical momentum band, 171. The stock is completely algorithmic overbought, and it is pressing dangerously close to the absolute maximum structural ceiling of 227. This is a high-risk structural disconnect. The algorithms have dragged this stock up as if it were a hyper-growth AI engine. But the underlying forward cash flows are contracting. For left-side fundamental buyers, there is no mathematical justification to accumulate here. you are paying a massive premium for negative growth. For right side momentum traders, this double breakdown without fundamental backing is your signal to pay extreme defense. Tighten your trading stops immediately as the statistical floor is sitting nearly $40 below the current price. To round out our 7 fundamental analysis this week, we check in on the updated number for XYZ. They just reported their earnings on May 7th, and the market's reaction has completely detached the stock from its underlying gravity. The current price is $71. Let's look at just now how far the algorithms have pushed this valuation. I want you to look at the massive spectral gap on this thermometer. XYZ's absolute best case fundamental ceilings stops strictly at 49. Even when according for a very healthy forward growth rate. Despite this, the current price is sitting in a completely different statistical universe at 71. Notice that it has even broken violently above the absolute ceiling of its 90-day macro statistical momentum band, $69. This is a textbook high-risk momentum overextension. The stock is floating with zero structural support and has exhausted its short-term algorithmic runway. For left-side value buyers, there is no mathematical justification for an entry here. You are paying nearly double the historical median multiple. For right-side momentum traders, this double breakout is a massive red flag. The fundamental error gap is over $20 wide, meaning an algorithmic mean reversion could be incredibly sharp. Capital preservation is the priority here. Tighten your trading stops aggressively. That wraps up our 7 fundamental analysis for this week. Today we saw exactly how much structural gravity matters when evaluating market extremes. We mapped out perfectly balanced growth entries in AppLovin, absolute structural safety in Berkshire Hathaway, and severe momentum warnings across AMD, Palantir, and Fortinet. The numbers tell the story. Your job is to listen to the math and position your risk accordingly. If you want to replicate these models and build your own valuation thermometers, head over to section 1.7 of the Quant Lab. Thank you all for joining me, and I will see you in the next section.